Now, let's cover what you should keep in mind when building your dividend stock portfolio. Above all else, diversification is the name of the game when it comes to dividend investing as well as other forms of investing. Imagine, for example, if you dumped all of your money into AT&T stock 5 years ago because you saw that it had an above-average yield. Well, a $100,000 investment would be worth just $73,000 today, assuming that you didn't reinvest your dividends. And even if you did reinvest those dividends, it would still more than likely be a negative overall return. If you had instead put $100,000 into VYM, the Vanguard High Dividend Yield ETF, the performance over the last 5 years has been about 35%, meaning that you would have about $135,000, not including any dividends that you earned. That's why diversification is so important. If you pick the wrong stock, you can lose a ton of money. If you're picking individual stocks, you also need to consider the type of industry that they are a part of. There are defensive industries, which are businesses that tend to be immune to economic fluctuations, such as power utility companies, for example. And then there are cyclical industries, which are businesses that are sensitive to the underlying economy, such as restaurants, for example. It's no coincidence that most of the dividend aristocrats are in defensive industries that see consistent spending no matter what. During a prosperous economy, companies in cyclical industries will often outperform, but during the bad times, companies in these defensive industries are going to be far more durable. Now, in addition to understanding the type of industry that a company is in, you also should have an understanding of the different business sectors of the economy. A sector is a defined segment of a broader global economy, and these are businesses that share the same related product or service. For example, the financial sector is all of the firms and institutions that provide financial services like banking and more. If you're choosing individual dividend stocks, you want to be diversified across all of these different segments of the global economy. The last thing I want to cover here are some common pitfalls to avoid as a dividend investor. First and foremost, you need to avoid chasing after high-yield dividend stocks. As you now know, a high dividend yield could simply be a result of a share price that's on the decline, and that will cost you far more than you're earning in dividends. Make sure you're looking into that dividend payout ratio as well to make sure that a company can reasonably afford to pay that dividend. In addition, you should also explore learning more about fundamental analysis if you want to own individual dividend stocks. This will allow you to better understand the overall financial health of a company, which is going to have a significant impact on their ability to pay and potentially grow dividends over time. And lastly, you need to avoid the pitfall of failing to diversify. It may not seem important during the good times, but when we inevitably enter a recession, that is when you will realize how important this is. So before this happens, take the necessary steps to diversify your portfolio. If you own individual stocks, for example, consider whether these are in defensive or cyclical industries. And in addition, consider what sectors are carrying the most weight in your portfolio and whether or not you have too many eggs in one basket. Always keep in mind as well that you can simply own an ETF or exchange traded fund if you don't want to worry about stock picking and you want to be diversified across all different types of companies.